And curiously enough, I'm now calling to the floor the author of the philosophical question that was long and generated another long philosophical answer, Domenico Pennucci.
I'll take that time out of my...
yeah, exactly. You take it out of your presentation. Domenico graduated here from the Rose program in 2010, and it's extremely nice to have him on the floor, also due to the fact that he followed a professional path that is different from the other alumni that presented before him, which is the fact that he's working in the insurance, reinsurance, broker industry, in this particular case in Carpenter. So I'm very much looking forward to hear his insight, his perspective from that other side of the equation. Domenico.
Thanks a lot, Rui, and thanks for inviting me to the presentation. It was such a pleasure. It'll be a bit different from the others, of course. I'm not in a research center or university, so I'll give a view from the industry, and specifically from the reinsurance industry, which is quite of a niche, and I wouldn't be surprised if many of you haven't even heard of it. So I'll start from the basics, and I'll give an overview, and I'll simplify things a bit for the benefit of the wider audience. But I think it's it's worth the time of giving an introduction to the field, because it's a very, very fascinating field, I believe. So what I'm going to talk about is give an overview in that first part, current practices, and show how these probabilistic cat models are used in the reinsurance industry, models that are not exactly this ESHM new model, but are in the same space and same sort of functionalities, I'd say, and then give an overview of what I believe might be the future challenges in the upcoming years. I've selected a few topics which are, I think, more interesting to me as well. So, current practices, what is reinsurance? For most people, insurance starts and ends there on the top left. You buy a policy contract, you hope not to use it ever in your life. In the unfortunate event you use it, you expect a claim to be paid to you, and that's the end of the story. In reality, from the insurer perspective, they will have to manage all these risks that they take up from all their clients, and not all risks are the same, especially in terms of volatility and in terms of correlation amongst risks. So if you take some type of business, you get little volatility, it's easier, let's say, to manage the risk over a longer period of time. Of course, when a catastrophe strikes, or such as quake or other natural catastrophes, but it can also be a man-made catastrophe. It can be pandemic now. It can be man-made conflagration or terrorism attacks. Then you'll have a lot of damages altogether in a given year, while maybe in the first 10 or 20 years you haven't had any at all. And in this case, the insurance company needs to guarantee the solvency capability in order to be able to pay the claims that take place all at the same time to their clients. But it's not only for the very, very large event, it's also for the medium sort of severity events, because maybe if an event happens every 5 or 10 years, they might be able to cover themselves, but in terms of balance sheet results and other financial implications, that wouldn't be an efficient use of capital. So these high correlation, high volatility risks, they make the diversification at national scale or even at continent scale not sufficient. And that's why then comes in the reinsurance market. So these insurers, they buy insurance cover from reinsurers. They transfer the risk through a reinsurance contract. Generally, there is a reinsurance broker in the transaction because of the global scale of the business and the complexity behind it. And the reinsurer is able to diversify these large severity, low frequency risks across the entire globe, so that a quake in Italy or in Turkey or in South America isn't as big as it would be on a national scale if you're actually underwriting business throughout the globe. Actually, the market is fairly complex. Reinsurers as well, if they have some sort of risk concentration, they might cede their risk even further to the so-called retrocessionaire, or even insurer and reinsurers, they might transfer part of the risk to the financial markets through what's called catastrophe bonds. So insured-linked security that investors, generally professional investors, can buy. So in order to do that, this intricate system, the market really needs common metrics to manage, transfer, and price risk. So they need to have a common language to actually be able to do business together and to transfer risk away from the source. So here comes the probabilistic cat models. There are these catastrophe models that will quantify the risk that is correlated to given perils, given a portfolio representing an insured portfolio representing the insurance. That would be fairly similar to what Ellen has just described, except it's not the built environment of the entire country, but it is rather the subset of that built environment that is insured by a given reinsurer, by a given insurer. These probabilistic cat models, they generally cover these four are, I'd say, the most four perils that are analyzed, at least in Europe. There is quake and windstorm, are two classic ones, have been around for decades and now are very well developed within the market. Then there are flood models that have been coming out in the last decade, thanks to computational advancements that made able for the development of such models. And then there is severe convective storm, that is the new, let's say, frontier of model development, which is strong linear wind and hail. It's particularly important because of climate change and what we've seen recently throughout the world in terms of climate change affecting this type of summer, extremely strong and quick events that create quite a lot of damage to the insurance industry. So these probabilistic cat models, basically, they really need to answer one question, that is, how likely it is to exceed a certain level of loss in a year for a given portfolio, for a certain peril. It might be due to a single event, generally, so due to a single quake or to a single flood event or a single windstorm, or all these events aggregated throughout a year. So these cat models can provide a complete risk of review, full frequency severity range for all perils, territories, and portfolios of interest. And they give, as I just mentioned, a common risk language and an efficient way of exchanging data and risk estimations. So let's take a look at the insurer perspective, and let's assume there is a European insurer with operating entities with companies in various countries in Europe. What they need to do to transfer this risk, and let's say they are in France, Germany, Italy, and Turkey, they need to analyze what's their catastrophe risk. So run these probabilistic cat models like quake for Turkey and Italy, flood for all the other countries, and windstorm for France and Germany. And the results of this analysis, they will feed into a reinsurance program for designing and optimize the reinsurance structure. So the overall limits, so the overall capacity, so the amounts that the insurance might be paid, in this example, 100 million, it's tailored to the probability of exceeding such a loss with a probability of 1 in 200 years. That's generally the type of low frequency we're looking at. But it will also, this type of analysis will also give a lot of additional risk metrics that are used to optimize the structure and also to give a pricing to the structure. And then all this data and analysis is distributed throughout the reinsurance panel. Generally, this risk is transferred to the reinsurance market, but it is not concentrated to a single reinsurer because of counterparty risk. So you want to spread this risk as much as possible, as it is practical. So the model results and the data that has been used for running these risk analyses are also distributed throughout reinsurers that will take a given percentage share of the overall risk. Down here there is the retention. This is the company will keep all the losses up to a certain value. that depends on the risk appetite of a given insurance company. And then the reinsurer's perspective. The reinsurer will take risk from a lot of different clients throughout the world, throughout different continents. It will receive different model data and results and catastrophe programs, and then they will need to aggregate all these risks. So a proper risk aggregation is fundamental, because as it is shown on the picture, there might be a single event that will hit a wide area of Europe, for example, and so together, at the same time, will generate losses on several insurers that can be even further away, states and countries that you think they are totally uncorrelated, while in reality they are uncorrelated, and they will sum up together, they will compound for the same event, and then the reinsurer will be liable for the payment of the claim to all European clients together at the same time. This rigorous risk aggregation is achieved by the scenario-based simulations that were cited before in the previous presentation. So you have stochastic event sets and stochastic scenarios that are used in all these different analyses. The caveat here is that all the analyses that have been run for the reinsurance transaction, they need to be consistent to each other. So you can't aggregate across models. So to aggregate more clients' losses for the same event needs to be equal in all the analyses that have been run for insurers throughout Europe, in Germany or Italy or France or wherever. So they will need to use the same model. Okay, so this has led to a limited number of CAD models that is generally adopted in each region peril. So there is generally a like first view and second view type of analysis on a given peril and territory. So there is a certain degree of formality and stiffness, I'd say, for very good reasons. Just in terms of a bigger picture, so the catastrophe risk is only one of the, I'd say, bricks within the entire universe of risks that a large insurance company needs to manage and be capable of repaying. So what we see below here, these are all the monitored risks generally in a given company, and the natural catastrophe risk is just this little bit here. Each of these risks will be reinsured appropriately. The catastrophe risk generally has a predominant aspect in that. Then all the risks, they need to be aggregated at line of business level. And again, correlation across risks is very important. And then ultimately, the company will need to be able to be solvent for all these type of risks together after reinsurance, after correlations, after all this calculation. And because there are probabilistic CAT models, the natural CAT risk can sit here together with all the others, even though historical losses are not there, or you might have historical losses only for 10 or 20 years, but your portfolio 20 years ago was definitely different to what it is now. And it really solves a lot of issues in terms of the application of probabilistic CAT models, a lot of issues in terms of managing, not only transferring this type of risk. Now, in terms of future challenges, this is a big topic. As I mentioned, I've selected a few. There are, I'd say, micro areas. Some are new challenges that are from the operational point of view, how these things are put in practice now and how they will need to be put in practice in the future. There is always a market evolution, new products and new needs. There is model updates. This is strictly correlated to the European seismic hazard model. In a way, there are new earthquake hazard models available at increasing frequency, but there is always a given latency of incorporation of these new models within the reinsurance industry because of the level of formality. I'd say there is the treatment of model uncertainties. Vulnerability, I believe, is still quite a big open question, and then there is the topic of unmodeled losses. So I've selected 4 out of these macro areas. One is aftershocks. So aftershocks, I believe, is a bit of the elephant in the room of quake risk estimation. For historical reasons, these probabilistic CAD models, they're used in insurance, but they inherit a lot of the assumptions that are used for design and for hazard applications, such as the time independency of events and the removal of aftershocks. Works well for life safety design, doesn't work so well, I believe, for quake risk estimation, because aftershocks are still covered by earthquake insurance and losses will be paid even if they are generated by aftershocks and not the main shock. However, the, let's say, correction of this assumption is not so easy because part of the aftershock damage is estimated in the current approaches. Because model calibration is generally performed using the economic losses of entire sequences. So just like we were saying before, when you calibrate the model based on economic losses from past events, those economic losses will necessarily include aftershock losses. You are not able to carve out aftershock losses and remove it from the calibration. The same goes for empirical vulnerabilities, if you use empirical vulnerabilities based on observations. But then on the other side, if you use analytical vulnerabilities, they really are not able to capture incremental damage, so the reduction of strength and stiffness because of accumulated damage, but also the fact that the same loss can't happen twice in the main shock and in the aftershock. If you have a total loss in the main shock, you can't have, again, a total loss in the aftershock. So also there, in a way you have overestimation, and the other way you have underestimation. But also another topic coming from the hazard is that historical catalogs might actually embed part of the aftershock impacts already in the main shock magnitude. Because for past events, we estimate magnitudes from historical records of loss of damages, historical description, and again, that description will include both the main shock and the aftershock. Then on top of this, it's really not only a matter of potential mean annual event rate underestimation, but there is also the fact of event clustering that is very important. So the time dependency, how the aftershocks are close to the main shock, that's probably even more important, because then in reinsurance there is something called event duration definition. So how long is an event? You know, a quake, there is no need to actually make that question, it's just a few seconds maybe, not for the reinsurance sector. So an event the duration is dictated by so-called house clause in reinsurance contracts. So all the losses that happen within a given amount of time, generally can be 100, 200 hours, 50 hours, 400 hours, it depends, will be compounded together as a single event. This comes also from other perils, because in windstorm or in flood, the definition of an event is not so straightforward. So here there is an example of the 2012 quakes in Italy, which is a very large event for the Italian insurance industry. The insurance industry paid more than $1 billion in terms of losses to the insured. And we had two events that were 9 days apart. So depending on your event duration definition, these two events that are similar magnitude might be considered as two events, two losses, or one single event. If they are two events, you get the first event loss, and then you seek to reinsurance, and you get paid from reinsurers 50% maybe of the total loss. Then you get the second event, you retain that loss, you don't get a payment for that. If you had a different event duration definition in the contract, these two events, they would be compounded together as a single event, so you would be paid more than half of the aggregated total loss that comes from all the private homeowners and industry and commercial activities that you have insured. So currently, this type of differentiation is not considered by the quake risk models. And you can't really model this, and it's an open issue. Another one is parametric quake insurance. This is also a favorite of mine. So parametric insurance is insurance that provides a payment depending on a trigger being exceeded generally. So it doesn't depend on how much loss you get, but it depends on if an event or a specific or something happens that is defined in the contract, generally is a quake happening somewhere or a given intensity being exceeded at a certain place. So there are advantages of transparency, so you don't need for claim adjusting, you don't need someone to come to your house or to your industrial plant and check the damages, speed of execution, and flexibility. It is better suited for certain type of application because of basis risk, so the payment might not be exactly the same as your loss. You might not get the loss and still get paid, or you might get the loss but not get the payment. So it's very useful for recovery costs, business interruption, public entities where you need a quick, in a quick way, a lump sum that helps you get back on your feet after an event. However, emerging technologies definitely will enlarge the field of application, reducing substantially this basis risk. So these are 3 generations of these events. One is called cat in a box. You get an event in a given grid, depending on the magnitude. This grid is defined depending on where your property is or how your portfolio is distributed, and then you get a payment. Or it's intensity-based. You say if the MMI or the big ground acceleration estimated after an event with shake maps, for example, at my industrial plant exceeds 50% G, then I get this amount of payment. So you reduce part of the uncertainty related to the attenuation. You still get quite a lot because this is, shake maps are largely interpolated. And then there might be a 3rd generation, a performance-based type of parametric insurance, thanks to the development and advancements in building health monitoring. You might have an industrial site that is already being monitored for some other reasons. You might use that type of monitoring system to actually record and register the performance of your structure during an event, like in elastic spectral displacement, structural period elongation, or even simply a spectral acceleration might be good enough to give you a very good indication of the level of payment you need to be capable of. Last 2 points. Currently, the way it works, reinsurance, it's a cycle, it's a yearly cycle. At the end of the year, you do on your portfolios a risk assessment, you design the insurance, and you transfer the risk. So it's mostly a picture, okay? And this is because until a while back, the computational efforts to do that was quite large. Now we are moving more towards an active portfolio management. Every time you take on new risks or you cancel risks that you had in the portfolio, you want to know immediately what's the impact on your tail risk. The impact on the tail risk, so for probability of exceeding a certain level of loss is highly nonlinear. It's not simply adding and subtracting. You have to rerun your entire portfolio. It's computational demanding. There are a lot of creative and innovative ideas on how to do this on the fly. And so you have strategic decisions and driving your portfolio evolution depending on a quantitative evaluation. But there are issues of data privacy, GDPR, because it is generally cloud solutions and network issues as well. And then the last one is other economic losses, which we'll see increasing definitely in the future. Currently, probabilistic cat models have been dedicated to the estimation of physical damage mostly and what's called business interruption. So business interruption is you're not able to follow up with your own daily business because of structural damage. So it's a consequence of structural damage. However, global business interdependency definitely has uncovered system fragilities that were previously unknown or they went unnoticed, and definitely they are unmodeled. And also advanced risk governance policies that definitely promote the estimation of cat event impacts in terms of not only reconstruction costs, but as a whole on a macroeconomic scale. So, this is 2 different topics, interconnected but slightly different. One is contingent business interruption. So you didn't have a physical damage, but you can't run your business because either you don't have providers or you don't have clients. It's what happened during the pandemic. Maybe you didn't have any structural damage to your, I don't know, restaurant or whatever activity you have, but you don't have clients, okay? That would be contingent business interruption, or, there is a flood in Thailand has happened and you don't get new material and you can't run your business. That's currently unmodeled, extremely difficult to unmodel. It will grow because of the globalization and the interdependence. And the other one, indirect economic impacts. It's whatever is not reconstruction, first aid, reduction of revenues, fiscal deficit, fiscal gains, and which ultimately results in a lack of growth development for entire regions, nations, which is generally unmanaged. But it can have long-lasting impacts, but extremely difficult to estimate. That's it. Thanks.
So thank you, Domenico. It was as fascinating as at least I had imagined. Thank you very much for all that insight. I will allow time for 1 or 1.5 questions because I've already seen 2 arms that went up. So John Schneider, and then potentially Michele Calvo. Potentially.
Thank you very much, Domenico, for explaining the role of reinsurance and the use of the earthquake data and models. And as you probably know, GEM is working, with you on trying to solve some of those problems with aftershocks and other factors into the modeling process. But I wanted to ask you, also in connection to the presentation that Helen gave, in developing open hazard and risk models, and the work that you're doing with GEM, how you see perhaps the importance of those models and the tools behind them in the work that you're doing. How is that improving your ability to make good models, good decisions, and say transfer risk in the best way at Carpenter and in the industry as a whole? Thanks.
Yeah, so it's definitely multiple use. Some of them are more direct, some others are a bit more indirect, meaning that, as I mentioned, the industry is rather stiff for a lot of reasons. And the fact that a new model comes into the market, it doesn't necessarily mean that even if it is demonstrated to be, latest science, it's difficult to distribute it throughout the industry because of the interconnection. However, all the central repository that GEM represents, the European Seismic Hazard Model represents, definitely works in various ways. One is model evaluation. Some of the models are newer, that are used in reinsurers, some are older. The new data being readily available in one central place is definitely useful for checking, evaluating models, also in a way giving some sort of competition push to some of the older models that are out there. So that's a more indirect type of application. Then there might be some other open source models that is not GEM or ESHM, which is more of an infrastructure, like Oasis might come to mind, that is more of a platform rather than a model by itself, that is slowly, very slowly being used somewhere in some places of the industry, and it might be easier to incorporate other open sources model like GEM or ESHM. The fact that it's so multi-peril as well is a bit of a difficulty in terms of incorporating new models, because maybe you get, the platform that are used are all multi-perils, and switching platforms sometimes is really a big operational load. Also because all renewal is done 1st of January, so you get 3 months of crazy period, and you have to rerun all the risk analysis throughout the world, and you want to be very, very efficient.
Very quickly, Domenico, do you think that the introduction of time-dependent evaluation of risk could be one of the future challenge? I mean, variation due to change in hazard because of an earthquake, or prediction of possible time-dependent prediction, or possible migration of exposure because of events and so on.
Yeah, definitely. So aftershock is one of the aspects of time dependency. If we stick to quake only, there is always a big discussion of time dependency in terms of main shock recurrence for some well-known faults that are expected to be time-dependent, like, I don't know, the North Anatolian fault. That's another big topic that is discussed. Then time dependency is really important for some other perils beyond quake. Then there is climate change in terms of evolution of hazard. That's the really hot topic currently, of course, as you can imagine. And in that case, you have different time horizon in terms of risk evaluation.
Thank you, Domenico. So with this, we close this session.